Well, I'd like to welcome you back to Down the Middle. Every single time I have a guest, I say they're a special guest and that you're in for a treat, and all the cliches that I can pull out to try and pump up the conversation that I know I'm about to enjoy, that I know that you will enjoy listening to. But I've yet to ever say a brother from another mother. And that's who we've got with us today. We've got Peter Boockvar. He's Chief Investment Officer of the Bleakly Advisory Group.
Thanks, Dan, my sister.
That's right. Yep. I'm going to tell a funny story about the end of Fed Up. And so as I was getting to the end of the book, and you walked through the manuscript with me in the whole way, there was a scene in the King Cole Bar in New York City. And we had brought together Sir Arthur Cashin and then Howard Silverblatt of Brooklyn, who's, the king of the S&P 500, and you, beer goggles, Boockvar, and me, and Richard Fisher. And it was a send-off, if you will. It was the closing of a chapter of an era in which you were, through me as a conduit, one of the chief advisors in terms of where your views were on the market to Richard Fisher. In his own final speech as president of the Dallas Fed, he referenced beer goggles. So why don't you give me your reflections on what it was like to become so close to Richard? He still reads you. And then you can tell us how long the bar has been at closing time, because it's been last call for a long time, Peter.
Well, luckily for us, Richard was one of the rare outside the box Fed thinkers. He was not your PhD economist. He had real life experience. He had market experience managing money. He had actually, as you knows better than anybody, just incredible amounts of different type of experiences, but importantly, that private sector experience that allowed him to sort of view the business world and the place of monetary policy within that from a different angle than the standard conventional PhDs at the Fed, that it seemed like once you walked in the door there, you all drank the same Kool-Aid and all had the same answers to every question. And that's what really attracted me to him and listening to his thoughts, whether he was a voting member that particular year or not. You always wanted to hear what his frame of thought was, because you knew it was going to be likely different than the consensus and where everybody else stood. And having the chance that particular night to meet him for the very first time was certainly a pleasure. Obviously, I heard so much about him through you, and you having the opportunity to work with him for so many years, and you as outside the box thinkers as I know on the world and the Fed, it seemed like it was a perfect match. And to be able to actually hang out with both of you at the same time in person in the same room was pretty special.
I'm not sure, thinking back on that night, whether Richard was happier to be in the room with Arthur or Arthur was happier to be in the room with us, and we were maybe just spectators, Peter. But we all got to marinate ice cubes together and be with two luminaries of the market. And I'll never give back those memories. Are there any Richard Fishers on the Federal Open Market Committee today?
I think Esther George. Unfortunately, she doesn't give that many speeches. But the ones that she has given over the last couple of years, she seems to be very independent-minded and sees things more similar to us, I guess you can say, and Richard as well. I think Robert Kaplan is not as much as Richard in terms of like the Dallas Fed frame of thought. I think he's more of the consensus guy, even though he does have plenty of private sector experience and certainly has his own views and that thinks different than others, particularly recently saying that he was really the first one to actually say let's taper sooner rather than later. So I definitely give him credit for that. Outside of that, unfortunately, there really aren't many.
It's interesting, Peter. I'll share an anecdote with you from somebody who joined the Dallas Fed shortly after Kaplan had joined. But he'd heard that when Richard came into pre-briefs before the FOMC that, I mean, Richard survives on very little sleep, 4 hours a night or so. And he would come into the FOMC briefing and there'd be all of us around the table, and he would have tabbed and marked and annotated the entire huge briefing booklet. And he would sit down and say, since this book has been written, what can you tell me has happened since? And that was it. He didn't want any. And apparently Kaplan has the full Socratic, the meetings go on for hours and hours and hours, and everybody regurgitates what they've written. It's interesting that it's so hard to duplicate him at the Fed. We might have gotten close with Judy Shelton, but it is interesting to see, Peter, and you can give me your thoughts on him, because since Fed transcripts were started to be transcribed in 1996, we've seen, I can count them on one hand, governors dissenting. It's so rare, and yet we have this new guy on the street, this Christopher Waller person who I wasn't expecting much from, and yet there he was speaking very plainly with Kathleen Hayes recently and saying, it's a white-hot housing market. Let's get out of that. Let's get out of the MBS space, the mortgage-backed security space. What are your thoughts on a governor speaking forthrightly?
Well, I think it was, and correct me if I'm wrong, I think this is right, that Wayne Angel might have been the last Fed governor that dissented at a Greenspan meeting, and we haven't seen one since. Mm-hmm. It was refreshing to hear what Waller said, without a doubt. I think the key question with what he said and what some others is that there's one thing to express the concerns. Like, we know the easy way of a Fed member to say that they're watching, they like to say, we're monitoring it. Mm-hmm. What about, they get the question, what about excesses here? Oh, we're monitoring it. What about this issue here? Oh, we're monitoring it. So to actually hear what that means, like Waller gave some substance to that line of thought, was refreshing. But it gets down to, what do they actually do? Mm-hmm. There's one thing to talk about. Yeah, we're focused on it, because they don't want to sound clueless. They want to let the world know that they're on top of things. They're watching the same stats that you are. They have the army of economists that work for them. They're on the phone all the time with all these businesses. They're on the case. That's what they want us to think. But there's one thing to be on the case, but there's another thing how you interpret what you hear and see, and then how you act upon it. And that's where I think there's been a disconnect for a long time. So
you kind of describe, and you're one of the first people I heard years ago to say we've segued into a confidence bubble with central bankers worldwide. I mean, it sounds to me that this is what you're describing.
Yeah, there's obviously no humility in the world of central banking, and they've went from sort of being the person behind the curtain for a while to really being center stage. And that obviously goes back to Greenspan, where he loved his lunches with the president and his hobnobbing with politicians. And he was the maestro, and he was the guy, and he was the guy at the helm that you can have confidence in. And that sort of feeling that he got from the markets obviously intensified over the years. And we know about the Greenspan put, and then the Bernanke put, and the Yellen put, and so on and so on. And now we're at a point where that confidence is sort of all encompassing. I mean, you want to be able to approach the investing world by looking at a company balance sheet or income statement, or looking at credit metrics for a bond or whatever. Where unfortunately for many, it's what's the Fed going to do? Are they in an easing bias or a tightening bias? And what's the level of QE and rates? And then people then work backwards from there. And it's a strange kind of world we're in. But I think also is that one thing that we don't get, and how I separate a conventional Fed thinker from one that's not, is are they self-reflective? Any successful CEO, any successful manager in a company, they're going to make mistakes. But it's those that pivot from those mistakes and learn from those mistakes that end up being successful. Mm-hmm. The problem is with government and institutional bureaucratic thinking is there's never that reflection or pivot. It's always, okay, if what we're doing is not working, let's just do more of it. And if it doesn't work then, we'll just do even more of it.
Mm-hmm.
And all looking for an end result. I mean, when you think about it, and again, these are all smart people with good intentions, but they, in a way, they look at monetary policy very simplistically. High rates bad, low rates good. Well, if low rates are good, even lower rates are even better. And if you're in Europe and Japan, if you get to zero, hey, screw that. Let's go even lower because that would be even better. And never a time of reflection. And interestingly, yesterday, Peter Pratt, who is the chief economist at the ECB, he was asked, okay, so here we are 7 years into negative interest rates. What do you think? And he admitted that that was supposed to be a short-term thing. Well, to my point with government, there's never anything that's short-term. There's always a doubling down and doubling down and doubling down to the point where they can never get out. And there's no change of policy. I mean, I've always been critical of the ECB in the sense that 80% plus of lending that takes place on that continent flows through the banks. So what does the ECB do? They damage the profitability of the banks by squeezing their loan margins, which then leads to less lending. And they think that that's going to be good for growth and get to the inflation that they want. I mean, you'd think that at some point they would sort of reanalyze the situation, but instead they said, yeah, negative rates is good, and let's just keep on doing more of it. And so I think that's the problem. And again, we all make mistakes. It's the ability to acknowledge the mistake and pivot off that I think is lacking in the world of central bank thinking.
So before I jump into the hot subject with you, which is the inflation debate, what's your favorite? If you were to be in the Eccles building around that big oval table, and they were to say, Mr. Boockvar, what is your go-to economic indicator? What do you think the most telling, revealing, accurate economic indicator is out there among all of them that we have?
So I like to. It's hard for me to pick one because I like to marry things.
Mm-hmm.
I like to listen to a lot of what companies say. I take it with a grain of salt. I mean, you listen to any home builder in 2005, 2006, and you think that the world of home building would never stop on their trajectory, and they didn't see what was coming. And you talk to any bank CEO in the summer of 2007, they had no idea what was coming their way. So you listen to what they have to say, but you take it with a grain of salt. But it is, I think, a good finger on the pulse of things by hearing about companies in certain industries that are affected by things that other industries are as well. You take obviously the semiconductor shortage now. It's not just an auto executive that's feeling the pinch. It's also plenty of people in the tech business too that is feeling that pinch as well. And hearing what they have to say and what they're seeing, I think, is important. But getting to my point earlier, you almost want to take them with a grain of salt. Certain companies are at different parts of the supply chain. You take like Intel, for example. The problem that everyone always had with Intel is that they were sort of at the bottom end of the chain. They were like the last one to know. So whenever there was a slowdown here, they didn't really see it until way after the fact. So it wasn't a relevant company to sort of get their accurate forecast of how the next couple of quarters were going to look. So I like to look at some of the companies that are sort of like real time, where things are happening quicker, particularly anything related to the consumer, because we know that's such a dominant part of the economy, and getting a sense of how the consumer is behaving, since that filters into so much of everything else, I think is important. I mean, obviously I like to look at, the CPI numbers or PCE, but by the time you see them, it's somewhat after the fact. I mean, obviously commodity prices, I like to look at. But a lot of the data we look at, there's always a lag. Now we have to deal with that. It is what it is. You're never going to get really anything that's such real time. Mm-hmm. So I think it's important to marry this all together rather than just sort of picking one here, one there. Because I think it gives a more complete mosaic to things. I mean, obviously weekly jobless claims are key, but there's always a story behind that firing. There's always a story behind that person who either came off continuing claims or stayed on it because they didn't want to take that job, and sort of trying to find corroborating evidence around that, I think gives a better, fuller picture.
Yeah, I think we're all kind of waiting for September the 6th to finally have a cleaner read, if you will, on jobless claims going forward. because in many ways, the federal government and the fiscal stimulus has been in place in an emergency mode now since April of 2020. And what we're learning as states exit these federal unemployment benefit programs early is that it doesn't take quite as much time to get an Uber driver. It doesn't take quite as much time to wait in a restaurant to get service. So it's incredible to me. And I think maybe you can speak to, because you've been following monetary policy for as long as I have. But this is kind of the first foray into kind of a double-barreled approach, because we've had monetary plus fiscal. And what difference do you think that's going to make in the current episode?
Well, it's a great point, because it's the fiscal side is really what we lacked in the recovery after the housing bubble. And even it almost went to the reverse when we had sequestration, where we really limited the pace of government spending, and where it was just monetary policy trying to light the fire, even though that was really sort of lost its touch. Where now, as you say, we have a combination, and no doubt that, and you just wrote about it, and quoting Milton Friedman about too much money chasing too few goods, and it's really the money part really comes from the fiscal side. Mm-hmm. It only comes from the monetary side is if you borrow it to then chase those goods. So here you had the cheap money, on addition to the fiscal side of creating way too much money, chasing then a supply problem that we currently have. So it also gets to is, why do central bankers to begin with want higher inflation? And there is no central banker that will be able to show you a model and say 2% is what is healthy for an economy, because that model does not exist. No. The only reason why they want the 2% is because theoretically they think if inflation is at 2, that means in a perfect world we have our Fed funds rate, or overseas or banks, their overnight rate, at least that or higher. Therefore, in an economic downturn, we have rates to cut. That's the only reason why they've picked that number. But getting to the point of no self-reflection, no pivoting, well, being married to an arbitrary number, look at the Japanese. Kuroda's been trying to achieve that number since 2013. If he was an executive at a company, he would have been fired in 2015, let alone still be around in 2021. And the same can surely be said for members of the ECB and other central banks. But what's also scary is this, getting back to the group think, Japan basically tried this for a while. And instead of learning from those mistakes, we have all then tried to repeat it and thinking that there would be a different result. And you and I have spoken about this in the past. You take the Reserve Bank of Australia, I respect it a lot for decades, because they never fell for the trap of negative real interest rates. They always felt that it was good to have their administered rates at or above the level of inflation. And they never experienced a lot of the booms busts that the rest of us did. Now, granted, they had certain bouts of housing excesses, but they never fell for it until, of course, recently, where they just sort of drank the same Kool-Aid that everyone had drank, and all thinking that, again, there was going to be a different result. And I just can't understand. We have a world of evidence of the efficacious nature of it and the harms of monetary policy, and they just all feel the need to do the same thing. I just can't for the life of me understand why they've all gone down that hole.
Well, and it seems, to your point, like in terms of no self-reflection, it seems like they're doubling down. We had the Fed come out with a new inflation regime last year, and now we've had the European Central Bank join them in saying that we're going to let inflation run hot. Take me back to the basics, because something I learned from you a long time ago is that even the inflation metrics that the Fed follows understate inflation by design. Tell me about, for people who don't read you constantly, what are the flaw designs in these inflation metrics?
Well, you take CPI, for example, and then we'll get to PCE. Well, first they have, and PCE too has the substitution thing, that they assume, okay, if you like chicken and the price of chicken goes up to such an extent, they assume that you'll stop eating chicken and you'll switch to beef. Well, some people don't want to switch to beef. They just want to eat chicken and are paying a higher and higher price for chicken. And there's no substitution there. So their cost of living continues to go up and they can't offset it with something else. Then they have hedonic adjustments where they basically embed in an inflation calculation an improvement in a particular product. And of course, it's mostly reflected in autos or even computers, that if the technological investment from one year to the next is up to an extent, that can offset any price increase in that item, even though I may not have an option in any other item. I mean, if I want to buy a car and there's in a certain price point, there's X number of models within that price point. If they've all gone up a certain percent, I don't care if I have all these new bells and whistles in the car. I still have to pay up 3, 4, 5% for that car relative to last year. So my cost of living is going up in the real world. It can't be hedonically adjusted lower. And then we also have a mix in methodologies where, and you were actually very good at calculating what the percentage of one's sort of expenses are allocated to housing of being around 40%, which happens to be the rate at CPI, whereas PCE is about half that, and healthcare is a greater percentage. And in PCE, the healthcare component, as opposed to CPI, where healthcare is calculating out-of-pocket costs, PCE is measuring Medicare, Medicaid reimbursement rates. And you ask any doctor, any hospital, what they just got reimbursed for a consultation or a procedure or a surgery from Medicare and Medicaid, and it's peanuts. It's essentially government price fixing in an uneconomic fashion the price of this good or service within healthcare that artificially suppresses it and explains why that, in addition to the lower allocation to housing, why PCE typically runs 50 basis points below CPI. And conveniently, the Fed, which never paid attention to PCE for decades, all of a sudden said, you know what, screw CPI, we're going to focus more on PCE. So here we have this whole monetary policy construct predicated on their pick and choose of an inflation gauge. And I argue the one they chose is artificially depressed in its largest component.
Yep. And Stanley Fischer, former vice chair of the Federal Reserve, would agree with you, by the way. And Alan Greenspan, who said that the most ideal inflation target was 0%, would agree with you. Looking back in history, it was Bernanke and Yellen who were determined to impose that 2% inflation target. And the minute Greenspan was out the door, there it was.
Yeah. I mean, when you think about inflation, we have technology that take the computer and the systems we're on right now, that they just go down in price every year as companies become more productive, and they make up whatever they lose in price, they make it up in volume. So let's just say the price of a laptop goes down 2% a year. Well, that means that something has to go up a lot more to offset that decline in that price. So I always want to ask a central bank, okay, you want 2%. What price do you want to go up 2% a year? You don't like gasoline prices when they go up, okay? Because that spooks them.
That's noisy.
They don't want prices to go up. They like it when technology suppresses them. Okay, so what prices do you want to go up to offset the prices that typically go down? And that gets to the point where it ends up being the services side of the economy that ends up being that upward inflation pressure that offsets that natural downward pressure on goods that benefit from, again, production efficiency and technology advancements. That is just a natural suppressant on prices where we do things more productively, and prices are a result of that.
So our mutual friend David Rosenberg explains that goods consumption is multiple factors of services consumption. And what we've just come through with stimulus check 1.0, stimulus check 2.0, stimulus check 3.0, and more fiscal stimulus than we've seen since World War II, that really it really disturbed the traditional construct that you just described between goods inflation and services inflation.
Well, we do spend a lot on goods relative to services, but the services is 60% of CPI. And that is because of the housing component. So to take out rents as a cost of living, and yes, only about 35% of the people of households rent, but I argue the 65% that own, they're paying 3, 4, 5% higher property taxes every single year. Mm-hmm. So that there's no property tax component within these inflation numbers, but I mean, my property taxes are double what they were when I moved in. Yep. And no central banker is taking that into account. They're looking at rent. So I argue that to take out the cost of living in housing and just look at what people are spending on goods and services not including that necessarily the housing, is not really accurate or reflecting the people's rise in the cost of living. Yeah, I buy a car once every 3 years if you lease. Maybe you'll hold it for 5 to 10 if you own. Yeah, I'm only going to buy a laptop once every, call it 5 years. Yeah, well, that's always the case. And we definitely bunched up the situation on the good side. But there's no stopping services inflation. So the whole inflation transitory or not debate is, where do goods prices go from here? Because you can be confident on where services prices are going.
Well, and I think, Peter, to your point, and you and I don't necessarily see eye to eye on the transitory, not transitory debate, but you can set that whole debate to the right-hand side. Our mutual friend, Arthur Cashin, I'm going to bring his name back up. He heard Dan Niles on CNBC mention the year 2004. And so he prompted us to have a look at what the discussion was around the table in 2004. All I did was search for the word transitory, and boom, 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 there it was. But in the background in 2004, to your point, we had housing prices really, really revving up. And if you looked at that April of 2004, when the CPI, headline CPI was 1.7%, then it popped up it popped up in April, went from March, and then it popped above 2%, and then it popped above 3%. But it was the housing costs that were becoming entrenched that ended up pushing the CPI beyond 5.7% in October 2005. That was housing. And it showed up with a really, really long lag. And I think that regardless of what happens with goods, I think the Fed's toast because of housing right now.
I agree. It's a really difficult spot they're in. And one of the fallacies of running things hot, because hot always overheats and then quickly flames out, where it's really better to have something that's more consistent and stable rather than hot. And it goes back to, who is the Fed to decide, the pace at which we are going to, interact with each other economically. It's always this speed up, slow down thing. And it gets to the whole thing about monetary policy, is that monetary policy doesn't increase the economic pie. It just shifts around where the money flows and pulls forward economic behavior. And one thing that I've always liked to say is that, one of the things that the Fed took on under Bernanke was this whole forward guidance thing. And they imputed in their models that if we tell the markets and the world that we're going to keep rates at a specific level for a specific period of time, that is stimulative. When in fact, it's actually the exact opposite, because you don't create any sense of urgency by saying rates are going to stay low for years, because people can sit and wait. Whereas if the cost of money just went up and down based on the supply and demand for it, we would act differently. We would behave more in line with where our savings rate are, where our investment needs are, rather than sort of being pushed and nudged and forced into doing things now before you really wanted to do it. Because when you think about monetary policy, it's like they're trying to make a deal with you. Okay, wannabe homeowner, I'll make a deal with you. instead of taking 2 years to save up for that down payment, how about this? I'll lower your mortgage rate right now, and you go buy that home now instead of waiting. And so you're not shifting that household's desire to own a home. You're just shifting the timing of it. And then, of course, that so much has been pulled forward, and then you get an inevitable hangover with no real increase in the long-term possibilities of the economy. In fact, you actually depress it because at the same time you're creating this incentive to take on all this debt. That's what also boggles the mind, is that, these central bankers have made them seem like they're heroes and that they're these noble figures, but all they're doing is just they're debt dealers. Instead of drug dealers, they're debt dealers. And they're in business to make you take on debt, because that's the only way that they have an impact, is by you taking on debt and pulling forward economic behavior and not waiting till tomorrow to buy that car, is to take on debt. And let's look around. Let's look around at the debt levels in the world. This was aided and abetted and encouraged by the nobility of central bankers.
We used to have Janet Yellen running the Fed, and she oversaw the most glacially slow tightening policy in the 100 plus year history of the Federal Reserve. And when she used to be up in front of Congress, and they would ask her about the markets or the banking system or regulation, her eyeballs would roll into the back of her head. So now we have this person running the Treasury Department. Take Mnuchin for what he was, good, bad, and in between. We know he profited from the subprime crisis, for example. But do you think that Janet Yellen is the right person to have at Treasury in the event of another disaster in the overnight rates market, as we sit here talking about the Fed's overnight facility pushing $1 trillion?
I don't know for sure, but you can probably bet that she does not have a Bloomberg terminal in her office, and she's not checking quotes just to see where markets are. Now, maybe she gets a call and say, okay, Janet, we're about to sell 2-year paper today. This is the pricing. But you make the great point that the crises that we've had at the Treasury level have been market induced. And if you don't understand the workings of the market, well, how can you really best respond to that? I mean, Janet, of course, is a believer in the powers of the government, whether it's the fiscal powers of the government or the monetary powers of the government. And, they can spend the right amount of money, and they can incentivize in their own way and get some sort of outcome. While she seems to be very nice and smart, she lived her career in surrounded by 4 walls and econometric models, and not out there running a business and meeting payroll or even trading the markets, where the markets have their problems. But the great thing about markets is that they quickly adjust when they're wrong. Whereas, to my point earlier, a government bureaucrat doesn't shift when they're wrong. They just do more. And it is a worrisome thing to think that if we ran into trouble, how would she respond other than let's just spend money and have the Fed, cut rates to zero and do QE. That seems to be just what's the only thing that's in their playbook, or something that I haven't seen before, but it's probably similar.
So the Treasury Department, politics, Congress. In August of 2011, we were at Camp Kotok when Standard & Poor's downgraded the debt of the United States. And we're 10 years on from that juncture now. And at the end of July, we've got the debt limit being hit all over again. S&P, when they downgraded the United States, they did so because entitlement spending had not been addressed, nor had tax policy in order to pay for all of the entitlement spending. So those were their 2 main reasons. You haven't addressed entitlement spending, and you haven't basically raised taxes to pay for all of this extraordinary spending. So here we are, a decade on, and instead of looking in the rearview mirror at midterms that were a slaughter, we're looking forward to the midterms of 2022. Peter, have markets begun to price in what's to come in this summer of 2021?
Well, it'll be interesting because politically, if you're on the Democratic side, you do not want to lose one house of Congress in November of next year. So you'll want to spend any amount of money to sort of buy yourself maintenance of control next November. The problem is that because the control is on a razor thin edge, it's going to be difficult. So you're going to have, I know, getting back to our friend Rosie with the fiscal cliff worries. There'll be worries, but of course now we're handing out child tax credit, so there's always a form of money that's flowing door to try to keep things afloat. I think, though, that there will be plenty of spending next year to try to maintain the economy at a certain level going into November next year. And I think it'll also be interesting what happens with Powell. I think about, like, I say, if I want to try to imagine if I was in his shoes. On one hand, I'd see what's ahead and I say, I want to get the hell out of here. Let's hand the keys off to somebody else. Well, if that's your thought, maybe you want to start the taper process and say, I started the exit. But you want to do it really slow because you don't want to screw things up ahead of February 2022 when you leave. You want to leave when things are calm. On the other hand, maybe he wants to stay, but he'll have the same thought. If he wants to stay, he doesn't want to screw things up either before February 2022 because he wants to substantiate why he's there and why he deserves a new term. So while I believe, are going to announce a taper, at least initially, it'll be really glacial because he doesn't want to screw it up. And that's what gets into what the Fed became under Greenspan versus what it was under Paul Volcker, who I know you've hung out with when he was alive, which is amazing, that he didn't care. He wasn't doing press conferences. He did what he felt he needed to do, where now that is obviously no longer the case. No politician and no central banker wants to preside over any economic decline. Just politically, they just don't, because you'll either lose your job in the next election, or as a central banker, you're looked at and bowed down upon, and how can you mess that up? So to your original question of how we go into next year and what that looks like, it's going to be really interesting. And it also ties in, I believe, to the story on how that plays out, because we know for at least the last 13, 14 years since Bernanke started QE and cut rates to zero, and then all the central banks did whatever they did, what gave them license to continue on was very low rates of inflation. Because we know, obviously, the criticism initially was money printing. The textbooks say it's going to lead to inflation. And when it never did, well, they were able to do what they wanted. If inflation is not transitory, if, I say if, we'll have to see, then they have less options. Mm-hmm. There's less, it really limits not only their ability to respond to any challenges, but it limits their ability to do things on a timeline of their wishes. Because as well as anybody, a central banker likes to have their own plan. And once they set out that plan, they like to stick to it. And if there's no inflation, then they have the opportunity to stick to it. But if you throw inflation, it'll be like throwing mud in the spokes of a bicycle. It could sort of like throw them off, where they can't go as fast as they want, or the bike is going to turn one way when they want to go the other way. So I think that inflation story not only is going to have a mainstream impact if it's not transitory, and again, it's if, it will have an impact on how markets respond, and importantly, what the Fed's response function will be. Will be in their control, or will they sort of be dragged along by the markets?
Yeah, and again, I think if you look back to that 2004 episode, what's so fascinating is that they completely lost control. Because, I read a Morgan Stanley report, I wrote about this, that single-family housing rental growth was 11.5% in the year through the second quarter. Class A and Class B apartment rentals in the United States, 9.2% year over year at the end of the second quarter. And this is Morgan Stanley speaking to the people who are actually charging the rents. This isn't an index that's conceived. This isn't some imputed number. This is the people who are setting rents. And some of it has to do with the rental eviction moratorium, because that's kind of held the market in a state of suspension, if you will, for a long time. That's ending, but nonetheless, this kind of inflation does not feel like it's something that can be pulled back easily, because when you're talking about an apartment lease or a lease for a single family rental, and we're still more renters than we've ever really been as a nation, that's not something that you can reverse quickly. That's a 12-month lease.
Right. And we know that the hotter home prices get, the hotter rental rates get. But what's the alternative for the Fed is to put the brakes on the housing market, through higher interest rates. But then that slows the economy. So it's doing the right thing does not include easy choices. But central bankers only want easy choices. That's why they always avoid sort of saying no to the child that wants more candy, or saying, you know what, I don't yet want to do my homework. So that is to a point where I don't know how this turns out. And the interesting thing now about the inflation story is back then, it really was mostly in housing. Now it's in so many other areas that I think it gets to the importance of when Main Street really starts to feel it, which when you look at the confidence numbers, we are seeing obviously an uptick in inflation expectations, even though longer term inflation expectations have remained muted, because most people that we know, that sort of 25 to 54-year-old, the upper end were kids in the 1970s. We just assume that any flare up in inflation will just recede, which obviously we hope it does. But what if it doesn't? And I'm not talking about high inflation. I'm just talking about higher. It's like when you think about 3% inflation for a couple of years, that's a problem.
Yeah.
That's a problem because of its impact on real wages, because even though wages are going up, it still is a crimp on real wages. And the world's bond markets, the level of global interest rates are just not prepared for anything that is sustainable. I mean, Christine Lagarde is at the poker table, all in with her chips that this is transitory. And you know what? I hope she's right, because none of us want to see something that's past transitory, but she's all in because she can substantiate negative interest rates and all the QE they're doing if it's not transitory, which is ironic because they don't want it to be transitory in order to get to their 2%, but not understanding because they're not market people that consistent 2% inflation in Europe with their bond market. So it makes your head spin.
Oh, it does make your head spin. But what I'm listening to, Peter, and this is something you've been writing about increasingly, is they're kind of damned if they do, they're damned if they don't. They don't have any easy choices. But are there any central bankers who recall a stagflationary era? And that's kind of the worst of all worlds at this point? I mean, do you think that is a potential outcome from the current episode, given, again, it sounds like central bankers have backed themselves into a corner?
So I like to see we're seeing stagflationary incidents, stagflationary stories in certain industries. And housing is the perfect example, where we know that the lack of inventory, aggressive home price increases has slowed the pace of transactions. That is a stagflationary type situation where you just ran prices too high. You look at certainly autos, and you have managers that are having to cut shifts and pause production for a couple of weeks because they can't get enough supply of not just chips, but steel and aluminum and paint. They can't even get paint on time to paint the sides of the car. So that is sort of a stagflationary type situation. And we hear stories about restaurants that can't staff 7 days a week and they have to be open 6 days a week. And instead of being open till 11, they have to close at 10 or 9 because they don't have enough people. That's a stagflationary type scenario. So we're seeing it in bits and pieces. If you're a home builder, forget about the price. But if it takes you, I always like to look at home building because I find it so interesting. It's sort of similar in a way where if you're like an auto assembly line, you're getting hundreds of parts from so many different parts of the world, and everything really needs to come in time because you can't get to this point unless these points are done. And it's just like building a house. It's like you frame it, but you can only frame it if you get all the lumber. And you can't put up the sheetrock until you get the electrician to put in the background wiring. And if you can't get that electrician because they can't get enough product to put in the wiring, then your sheetrock is held up. And if your sheetrock is held up, then you got to push out getting the tile or the wallpaper, and everything gets clogged up. And it actually gets into also a discussion on the whole just-in-time thing. And just-in-time was a great thing because it made things run efficiently. And if you're a company, you didn't need to stock too much inventory, and you had less working capital needs, and you had a cleaner flow of things. And I argue with COVID that, at least for a while, just-in-time is dead. And you need to stock more things on the shelf because you don't want to have to tell your customer that it's going to take 2 more months to get a washer and dryer if your customer is a home builder, and they now need to delay, finishing the house, or getting an HVAC system because Train and Carrier just told you got to wait a couple extra months. So you're going to stock more stuff. That reduces your inventory turns. That's a drag on cash flows, and maybe you're going to have to raise prices to sort of mitigate that impact. And that is just beginning. So even when manufacturing does sort of clear itself to an extent, it won't go back to the way that it was pre-COVID.
Well, it's interesting you bring that up, Peter, because in discussions with housing experts, they're hearing echoes of 2005, 2006 from the public home builders. The private home builders are like, they can see they can see over the horizon. They can envision all of the lag times that you just described. And at the end of that, they can also see faltering demand because so much demand has been pulled forward. So you really are getting 2 separate narratives right now from the public versus the private home builders, which is just fascinating. And you've been following economics for as long as I have. I've never seen a cycle act in such a compressed manner as what we're seeing right now. This is really remarkable what we're seeing in some of these indicators.
It really is. And to your point you just made, I mean, if you're a Whirlpool and you and Toll Brothers and Pulte and KB Homes are your big customers of yours, they're your priority. The small builder that maybe builds 5 to 10 to 20 homes a year, they're at the bottom of the list. Mm-hmm. They are not getting that washer and dryer ahead of the big home builders, those big customers. So that is also going to create its own problems as well. And it clogs things up. And getting back to housing, when you think about if you make it unaffordable for that first time buyer, that means that trade up buyer who owns a home wants to get a bigger one. Well, they have less people to sell to. Yep. Well, and they don't move out. Now, of course, that first time buyer is being replaced by investors and private equity and the buy to rent. And that is sort of maybe clearing some of those homes, but it's screwing that first time buyer. And then imagine, and it may not be the case, let's just say rates go up. I mean, our generation doesn't know what a mortgage rate is with like a 4 handle. I'm not saying that rates are going to go there, but let's just say they did. We'll have locked in so many people that are not going to want to give up a 3% or 2% down mortgage. I mean, that's down the line. I'm not saying that that's happening anytime soon, but
it is. But we've already seen it play out once. We've already seen mobility stunted one time because of the last generation of low mortgage rates. So, I mean, we've read this book before. This could easily repeat itself, but even in a more entrenched way. So the best thing to do, therefore, if you're the new administration, is to reshape the Federal Reserve based on your vision of what the U.S. economy should look like. I'm positive that you saw these headlines, and I have to ask for your reaction to the idea of saying out loud that I want to form a Federal Reserve that bids my doing, that carries out fiscal policy. I mean, what kind of a world are we? I thought this was an independent, apolitical institution. I thought that was in the 1913 Federal Reserve Act.
Well, our mutual friend, Mark Gomez, I liked his term used a while ago, the Treasury, combining the Fed and Treasury. But what's interesting is that I don't want to criticize some people for just not fully understanding, but there's a very simplistic way that some people in politics look at monetary policies: low rates good, high rates bad, even though they're not looking at, well, low rates is making housing unaffordable for your constituency. It's raising the cost of living above the rate above the increase in wages for your constituency, and it is reducing, therefore, the standard of living of your constituency. Unfortunately, there's not enough people that connect the dots. And that gets to one of the things that central bankers, I talked about them having license because of low inflation. They also have license because not enough people understand what they do and what the impact that they do is on daily lives of households and businesses.
Yep.
Most people don't understand. They don't connect the dots. And that's why the Fed has avoided a lot of public criticism. It's because people just don't fully get the influence that they have on so many different things. I was listening to TV this morning, and a reporter was interviewing Sherrod Brown, the congressman, and the question was, what can the Fed do about helping the wealth and income inequality? And obviously the questioner didn't understand, and certainly Sherrod Brown's answer clearly didn't understand the Fed's reason for particularly wealth inequality. And unfortunately, if you don't understand, well, then you're just going to let them continue to do what they do.
That was actually going to be my next question was, why is there, and you know what, Peter, I'll be jumping the gun if I get to this. I'm going to hold on to income inequality for just a minute, and just hit on two subjects: climate change and diversity. Do these have any place in central banking? Do these have any role in monetary policy?
Zero. If price stability and employment are your main goals. Now, the ECB will say, okay, we're sort of supporting climate change because we're no longer going to buy the bonds of Total in France, and we'll buy the bonds of wind farm companies instead. And I guess if that's their way of climate change, but the thing with climate change is, okay, we can argue, the extent of it, but even if you can say, okay, we're having it, trying to figure out what the economic implications of it are virtually impossible. If you live in Siberia, you're going to love a little bit of global warming. If you live in South Florida or Dallas during the summer, you may say, you know what, it's a little bit too humid. I wouldn't mind a less humid summer. So I don't even know how to quantify the economic impact, putting aside the whole climate change, original discussion. How do you quantify it? And if you can't quantify it, then how do you make policy around something you can't quantify?
Agree on all counts. So now let's get back to income inequality. So in theory, well, first of all, what are your feelings about where valuations are right now? Given we've described that a few things could go wrong here and there going forward that are not in central bankers' control. But what are your feelings? I mean, we're in the 99th percentile of valuations, but yet if you're on my Twitter feed or your Twitter feed, valuations, they've ceased to matter. They don't matter anymore.
Right. I like to say valuations don't matter until they do. They can stay rich for a while, and they will matter when they do. And yes, so there's. I think it's tough to argue that they're not rich, particularly stocks trading at low 20s multiple, credit spreads that are obviously tight as a drum, and triple C credit that's yielding less than 6%, and high yield, or I should call it junk, yielding less than 4%. I mean, things are rich. We all know it. It's just a matter of when it matters. And historically speaking, it does begin to matter when you get a change in interest rates or you get a change in monetary policy. That's when people pay more attention to valuations. When the Fed is easing, when rates are low, well, there's what's the difference between paying 30 times, 40 times, or 50 times earnings, or for some companies, a multiple of sales? It doesn't really matter. But when the tide turns and the cost of money changes and where monetary policy is shifting another way, well, then people start to become a little bit more discriminating on valuations. And we did get a taste of that in the first quarter with the rise in interest rates. And people said, let me rethink how much I want to pay for this tech stock. Mm-hmm. And maybe that value stock trading at 10 times earnings doesn't look too bad anymore. Maybe that all of a sudden is attractive if the cost of money is going up and I don't want to pay too much for that other stock. Now we're sort of kind of in a strange position because rates have fallen and we've shifted back to, let's just pay anything for tech growth because that's the only place we're going to get it. And who cares about valuation as long as the company is growing? Eventually that hits a wall, but trying to figure out when is obviously always very difficult. And, managing money makes it that much more difficult because you either get dogmatic and say, you know what, I can't pay that. And then that part of the market keeps going up and you're missing it. You got clients calling you saying, how come I don't own this, this, and this? And you'd say, well, it's trading too expensively. I don't want to pay up. Right. They laugh at you. They don't care about that. They want to own things that go up, avoid things that go down. And valuations in that context don't matter.
And so and this is probably something you understand better than most people, even as we've seen a reversal in that spike in interest rates, gold has found a floor. So, there are certain myths surrounding gold, and maybe you can help dispel some of them.
So I like to look at gold as just trading off two things: where the dollar goes and eventually all fiat currencies, because you do have times when gold and the dollar can rally at the same time, but also where real rates are. Don't look at gold as the world is falling apart, the sky is falling. Don't look at gold as a safe haven when there's geopolitical problems. Don't look at gold as a hedge against the stock market. Just trade it off those two things: real rates and the direction of the dollar and fiat currencies generally. We had a pullback in gold and silver this year when we saw, the sharp rise in rates, because basically real rates, even though it was joined by a rise in inflation expectations, real rates pretty much bottomed out last summer. Now, real rates have fallen again over this past week with a sharp drop in interest rates, but then the dollar has rallied. So while gold may have been a beneficiary of the drop in real rates, the bounce in the dollar, with the dollar index now call it 92-ish, 93-ish, has been a headwind. But me being a bull and long gold and silver, it's been sort of a maddening experience because you think that the world is really set up for a nice rally in gold and silver. But if I am right, and again, if that inflation will remain sticky here for longer, I expect real rates will remain very negative. And I'm long-term bearish on the dollar because of basically the twin deficits of the budget deficit, the trade deficit, having a decent correlation over a long period of time with the dollar, that gold and silver will have their day. There aren't many assets that are down 50% from where they were 10 years ago, and silver qualifies. And even taking a step back from gold's 1,700, actually 1,800-ish. It's only $200-ish off its all-time 4,000-year high. So if that's some solace to other gold bugs out there.
4,000-year high. So what of the idea that cryptocurrency is a substitute for hard money?
I have a lot of respect for the whole crypto space and the basis of Bitcoin. I mean, we know Bitcoin was created in response to, wow, we have central bankers that are printing all this money. We need to create something that is finite in nature, can't be printed away, can be used as a medium of exchange, certainly a store of value. And digital, so what? It's still limited. So there's a lot of similar thinking, being a gold bull and appreciating that. My only issue with Bitcoin generally, and then we'll get broader crypto for a second, is that I don't know if Bitcoin should be worth $50, 50,000, 500,000, or 5 million. I don't know. I think in 10 years, 20 years, Bitcoin will still be around. I just don't know what price it should be. I'm much more confident that, yeah, crypto is a new technology. It's very fascinating. Right now, this whole DeFi thing is really only for a small portion of the financial sector. And yeah, this could grow in the tokenization and so on and so on. And it's something that I'm trying to teach myself, and I'm trying to learn about it, because if it is something that has legs, I want to understand it and hopefully be a part of it in some way in terms of, investing. But Bitcoin replacing gold, that is complete nonsense. Something that's been around for 13 years is not going to replace something that's been around for 4,000 years. It's just not going to happen. Now, they can complement each other for sure, but I'm just more comfortable owning gold than owning Bitcoin. But again, I have no opinion on where the price of Bitcoin is going, and I respect the thought process and the bull case for it. But it's still trying to get my hands around something that you can't physically hold and touch.
I've got bad news for you, Peter. That you just showed some serious humility, and you do not qualify to sit on the Federal Reserve Board. I don't want to ruin your day.
I do not.
So it wasn't too long ago, there were protesters storming the Banque de France. So there's a difference between where we are today as a society versus where we were going into the financial crisis and the bursting of the housing bubble. There is a greater awareness, I think, of the role that the Fed has played. And let's say hypothetically that we are going to have 3 busts inside of a 20-year period. Do you think, have you noticed, because of this inequality divide, have you noticed, because I have, but maybe I live in a bubble, the anger element that is being directed at the Federal Reserve?
Well, I think the anger element, unfortunately, right now is at sort of like the institutional level, where we understand their influence. I wonder if I should take a step back. Yes, for the retiree, for that baby boomer, you're 100% right. Because they don't have to know much about the Fed other than they're the reason why I get 0.1% in my CD. So yes, you're spot on with 10,000 people every single day turning 65. And the Federal Reserve has basically screwed up a lifelong retirement plan because of what they've done to the level of interest rates and how they've forced people to take extraordinary risk just to get some return. I sort of feel that angst every day because a lot of our clients are just retirees and hardworking people that are just like, I need some income to live.
Right.
And I try to spend every day trying to find them opportunities. And it seems like every day that job gets harder and harder. So yeah, that anger is being directed at the Fed. It should be directed at the Fed. And you wonder like what reverses it, because if we get a rise in rates, then there is going to be pain on the other side. But we need to get out of the model of Japan. We need to break free, but there'll be pain that is associated with that. But you know what? If Lael Brainerd replaces Jay Powell, all our wishes and hopes will go out the window, and we'll just get more of the same.
Modern monetary theory monetized. Even though I will say, and this is not a political statement, but I think Congress can have sway depending on what the outcome of the election is, just in terms of reining in the spending that is authorized. And we can stop and look back as a nation and say, wait a minute, maybe all of this spending that's fueling monetary policy is part of the cycle that we can't break, is that they keep feeding off of one another.
Well, to that exact point, I do believe that the administration has become more sensitive to the inflation talk. And even if inflation calms down, they are at least being asked the question is, what do you think about inflation? Now, obviously, even led by Janet Yellen saying it's all transitory, but that they're being asked the question, I think has maybe tempered some of their ambitious spending wants.
Mm-hmm.
And that because they know, I mean, just look at the irony this week that Biden and company are talking to OPEC and the Saudis about keeping the price of oil from going higher. So they want to limit the amount of drilling, but they want to have more drilling to keep the level of oil prices from going up. So I think they've become sensitive to this inflation discussion because you have to believe that there are a lot of constituencies out there calling their congresspeople every single day complaining about the rising cost of this or that.
Yeah.
Relative to their wage growth.
Yeah, I mean, I can tell you that the price of beef has nearly doubled in the space of 12 months in my house. And that's like something that you really stop and pay attention to. I mean, it's extraordinary. And you say to yourself, how is this affecting the average U.S. household? And I think that maybe this is a good wake-up moment of maybe turning the fiscal spigots off and doing a little bit more, as you started out by saying, self-reflection. Well, we're not going to figure out all the problems of the world today, and we get to go fishing pretty soon, and I'm really excited about that. But I want to end today by bringing up a really momentous anniversary and having you explain the role that you played years ago, just a few years ago, when it comes to Back to the Future, which has just celebrated its 35-year anniversary. And I'm joking with you in a public forum on Twitter about it, saying nobody knows what I'm talking about because it's an inside joke. Can you tell us a little bit about your son and a role that you played?
So my son's bar mitzvah back in 2015, a while back now, we made, when I say we, my wife and my son and myself made a video. I rented a DeLorean and he went with me playing Doc Brown, took him back in time to introduce himself to his parents that had yet to have him, and to one day, 13 years later, encourage him to study his Torah portion and learn his Hebrew so he would be ready for his bar mitzvah. So I put on the Doc Brown costume and unfortunately, I was not able to drive the DeLorean, but I sat in the DeLorean with my son and we had a little Back to the Future video. So,
well, if you
and also hired a Michael J. Fox lookalike to do a pass by.
Oh gosh, so 6 years has gone by, but just the same, it was marvelous to watch, Peter. And on behalf of the producers, I hope you might be able to send us a screenshot that we can put up as well at the end of this interview. I look forward to catching up a month from now. Let's come back and revisit Transitory in about what did the Atlanta Fed president say? It was maybe 9 to 12 months. So transitory is being warped, right? As a word.
Everyone's got their own definition.
Everyone's got their own. But let's come back and revisit this in 9 to 12 months and
love that.
And see where we are with this great debate. And in the meantime, I would so appreciate you taking the time, Peter.
I'm grateful that you had me so much.
Thanks. Well, I hope you enjoyed listening to Peter Boockvar, my brother from another mother, as much as I did. And it'll be interesting to see how this inflation debate plays out. How is inflation affecting your life? Let me know. Shoot me a comment. I'd be interested to hear. It's certainly something that we're all contending with in different ways, rising prices. I would suggest, if you wanted to see the other side of that debate, if you did miss a recent interview that I did with David Rosenberg, go back and check that out. Have a look, just so you can see the two different sides of the spectrum intellectually. And with that, I will remind you, please, if you have not, subscribe. And I will see you next time for the next Down the Middle. Thank you.